Thanks, Jeffrey. Well, the Dow finished up nearly 50 points today. And just the day before yesterday, it closed at a 13-month high. If you look just at the Dow-Jones Industrial Average lately, you might believe that the U.S. economy is robust and bullish. But reports on just about every other sector of the economy don't seem nearly as rosy. So, is it just a case of Wall Street trumping Main Street? Or is it a little more complicated? And joining us to hopefully answer some of those questions are Edward Stuart, economics professor at Northeastern Illinois University, Jim McDonald, chief investment strategist at Northern Trust, and Revel Cole, finance professor at DePaul University. Thank you for joining me tonight, gentlemen.
You're welcome.
Well, let's tackle that first strange question. Why is the stock market up so high when everything else in the economy looks so dismal, particularly unemployment? Let's start with you.
Well, one of the kind of good news pieces is that even though we still have increases in unemployment, the increases are getting smaller. So if you look at a graph of what's happening to unemployment, it's gradually kind of moving in the direction where we may eventually add jobs. And people who are stock market analysts can see the fact that the declines in unemployment are getting smaller, and that's what has to happen before we start adding jobs. So if the labor market continues to improve the way it has, I think that sooner or later the real economy will catch up with the stock market, which is usually the way that the timing works in that kind of sequence. The stock market gets better before the real economy improves.
Revel Cole?
I think we've been looking at different figures because the unemployment rate jumped from 9.8% in September to 10.2% in October. If you look at the household survey that the Bureau of Labor Statistics does, almost 1.5 million jobs lost just in the last 2 months.
So you think unemployment is getting worse?
It's getting worse.
Okay, so why then is the stock market getting better? That's the first question.
I can say two things, momentum and math. There's momentum playing right now that it's been going up and it's continuing to go up. There's also the math. Remember the market was a high of 14,000. It fell 50% to 7,000. Now it's up 50%, but we're only at 10,300. We're still down over 25%. So it may look good from the bottom, but it doesn't look very good from where it was in 2007.
Well, it might look pretty good to investors who are looking at their portfolio. What about you, Jim McDonald?
Elizabeth, I would say that the main factors that have led to a better stock market have, number one, been global central banks have been successful in improving credit markets. So that's helped the largest companies. It hasn't gotten down to the small ones yet, but it has improved. The second thing is the global economy is better than the U.S. economy. So global economic growth this year is going to be about 2.5% negative. It's going to be about 3.5% positive in 2010. Stock market likes accommodative central banks and good economic growth. This isn't a free lunch, though. There will be a price to be paid for this through the increased debt, and the Fed's going to have to remove the stimulus. But right now, good growth and good liquidity is driving the market.
Now, Jim Cole, you told our producer you thought this was a big bubble and that it was probably going to drop back down to 7,000 or 8,000.
I can very easily see a correction of 20 to 30%, taking us down to 8,000 or even the 7,000 level. As far as the accommodative Fed policy, the Fed is the only one who is even participating in a lot of the credit markets. The securitization market is still frozen. There's virtually nothing going on in the securitization market. The only reason that you're even able to get a mortgage these days is because the Fed has bought $1 trillion in mortgage-backed securities during the last year, while it blew its balance sheet up from $1 trillion to $2 trillion. At some point, it's going to have to take that money out, and at that point, the housing market is going to crumble, but it's already crumbling as it is. The foreclosure and delinquency rate hit an all-time high in September, and then again in October. There were 600,000 new delinquencies in October alone. Compare that with the 500,000 loan modifications that the administration is touting.
Edward Stewart, is it all that bad?
There's some bad news and there's some good news. I agree with Jim. The financial sector has been stabilized by the actions of the Fed and the Treasury, and also the European Central Bank, the Bank of England, the Bank of Japan. One of the good things about this Great Recession is that we learned at least some really valuable lessons from the Great Depression. That everybody has kind of realized that the world is one economy, and central bankers have acted more or less together. Treasuries and central governments have acted to be stimulative. We haven't had big increases in tariffs and cutbacks in foreign trade that we had in the 1930s. And so I think this is kind of grounds for optimism that we know some things. Obviously, we don't know everything, and there's a lot of uncertainty. But given the real sick nature of the patient a year or so ago, the medicine has been pretty effective. I mean, the patient hasn't died, it hasn't gotten worse, and I think eventually it'll get better.
And are you saying, Rebel Cole, that the patient is still on the deathbed?
I think, again, I'm coming from another planet because the banking industry is in terrible shape. For the first year since, I think, 1992, we've had over 100 banks fail. We have the highest non-performing loan rate in the banking sector since 1991. Bank and lending is down at a 19% annual rate over the last 3 months. Business lending is down at 28% over the last 3 months. I don't see where the green shoots are, especially when you're talking about the financial system.
Yeah, Jim McDonald, bank stocks are going up.
Bank stocks are going up. They actually were the catalyst to the market rally in March. One of the benefits of the Federal Reserve keeping the yield curve very steep, so short rates low and longer rates high, is that it's improved profitability of the banks. That was one of the reasons they've done this. With respect to the housing market just needs to stabilize, and I don't think it's going to see much appreciation for years to come. But that at least allows the banks to have some ability to value some of these toxic assets they've had. That stability is helpful to the economy.
But there is more, credit is flowing much more freely. You were saying you don't agree with that? The credit is flowing much more freely?
It's flowing more freely largely because the Fed essentially underwrote the risk of the entire financial system. Once the Fed starts pulling back some of those programs, the question is, will the private sector and the banking system be able to pick up the slack? And I just don't see it happening.
What do you think?
I think the people at the Fed and the Treasury understand that they are, in many ways, the life support for the patient that's still pretty sick. And so I think there's a fairly clear understanding on their part that, yes, eventually some of the liquidity will have to come out, and also the fiscal policy will have to be a little bit more, shall we say, mature, and taxes will have to go up and spending will have to go down. But I don't think anybody sees that happening in the next year or two, at least. So, yes, we know that
it'll be up to the Feds to keep that liquidity in the market.
Right, and I think they understand that, yes, they're going to have to take a little bit of the liquidity away. They'll take the patient off of intravenous feeding, but like any good doctor, they'll do it very, very slowly. And if there's a relapse or the patient gets a little bit sick, they can jump back in and add liquidity. I think that's part of the understanding that we've gotten through 50 or 60 years of economic policy and the kind of the real lessons learned from the Great Depression.
Well, let me get back to the market a bit. I mean, certainly Wall Street is looking pretty good right now, given what's happened in the market. But Main Street is still struggling. Yeah. Is this Wall Street versus Main Street?
Well, it will be to a certain extent for probably the next couple of years, because there is likely to be a very slow recovery in the employment picture. If the economy grows at 3.5% a year, we're probably not going to meaningfully reduce the unemployment rate. The only positive aspect of that is corporate profitability right now is really high, and so corporations are starting to reinvest. That's one way to get growth going again. But the thing to take away from this is don't focus just on the U.S. economy. There are plenty of economies outside the U.S. that are doing much more robust growth and have got stronger financial systems. So your portfolio can also benefit from that and not just be concentrated in the U.S.
But I still want to know why we can't be pleased that the stock market is going up. I mean, even 401ks, people's 401ks are being replenished as the market goes up.
I think we can be pleased that the stock market is going up, but I would not want to leave the impression that that's the only thing that we should worry about, or that that's the end of the story. I think personally that we probably need more stimulus in the form of direct government spending on things that will put people back to work, because the unemployment picture is getting better slowly, but still in manufacturing and construction there's still really almost depression-like situation. So we need to do a lot more spending on things like infrastructure and rail and airports and bridges and roads and the CTA and those kinds of things. And those kind of direct stimulus efforts, I think, still need to be done, and we'd be happier, I think, from that.
More stimulus efforts?
I think he's hit the nail on the head that what has been done has not been addressing the real problems. The real problems we have are a real estate sector, especially the residential, that has cratered. The commercial sector is cratering, and the labor market has cratered. We need to address the labor market and the housing market.
By stimulus?
one way we could provide stimulus, I don't think we need to do infrastructure. I don't think we need to be spending the $800 billion the way we spent the last $800 billion. But how about something innovative? Like let's suspend the payroll tax for the next year. That's a 15% pay raise for every worker. It allows small businesses to hire new workers, and it allows small businessmen who are in that tax bracket to take home 15% more pay. It would immediately translate into much more jobs. If you look at the cost estimates for the jobs that we supposedly saved or created with the $800 billion stimulus, it's abysmal. It's like $200,000 to $400,000 per job. You give a small businessman $200,000, $400,000, and he's going to create 20 or 40 jobs.
But at the same time, you're saying that the stimulus has been essential to the liquidity of the markets and to the...
Not the fiscal stimulus. I'm talking about the actions of the Fed and pumping liquidity in the financial market. That's a whole different ballgame from the fiscal stimulus package.
I'm going to take the opposite side of that at this point, which is that I think there has been enough stimulus, and we still have not spent roughly half of the stimulus plan that was put into place earlier. And the financial markets right now are much more focused on starting to control the deficit. So worries about more financial spending out of the federal government, I think, actually would not be well received by the financial markets.
Let's talk about the dollar. Now, obviously we have a very weak dollar, but Timothy Geithner said in Tokyo that the strong dollar was very important to the U.S. economy. Does he believe that?
No. No, he doesn't.
Why
he
did
has to say that. He has to say that because there's political cost to saying a weak dollar is good. But at the present juncture, as Jim has pointed out, the global economy is doing fairly well. The Asian economies are expanding. The European economies that have much more kind of built-in stimulus and income protection are doing well. South America is not doing badly either. And what the United States needs to do...
Why are they recovering faster than the United States?
Well, they haven't... We are the ones that started, right? It was our financial system that was in the worst shape and our kind of mess that spread to the rest. And so... that's one of the reasons that we were the really sick patient, and they just kind of got the disease secondhand. So the fact that the dollar is weak means that U.S. exports are relatively cheap, and that's one of the places where we can expand output and then eventually employment and help the unemployment rate. So it may be that one of the things that's driving the Dow is the fact that the dollar is making U.S. goods and services a lot more competitive. And any of your viewers that have traveled lately and had to buy euros or British pounds or Swiss francs knows that if you've got friends in Paris, it's much easier for them to come here than you to go there, and that's what the price system and the exchange rate is supposed to do, and will help the U.S. economy as well.
Rebel Cole, weak dollar at this moment, probably good for the economy?
Probably good at this moment. The reason the dollar is so weak right now is that the Fed has said that they're going to keep interest rates low long term. Many of these other countries have already started raising their rates. And then back to the point that was just made, this was our mess. It was our subprime crisis. It was our mortgage-backed securities and our CDOs that we polluted the world financial system with. And, so ultimately those bad assets, the real assets underlying those financial assets are in the U.S. And we haven't dealt with that problem. That's the big problem with this recovery is we haven't fixed our banking system. And until we fix our banking system, our economy is not going to grow as it should.
Well, Jim McDonald, given all that cheerful news we just got, what is your outlook for the market?
Well, we think the market can continue to advance, but at a much more measured pace than we've realized year to date. With the central banks continuing to be accommodative and the economy continuing to grow, that is a good investment environment. But all the focus is on the removal of this stimulus by the central banks. And the big risk case is if the Fed gets it wrong, they have this $1 trillion worth of mortgage-backed securities on their books. If they don't handle that deftly, that could create a investor concern about inflation and about growth, and that would be a disruption to the more positive outlook.
And what's your prediction?
Well, it depends on what the federal government does in terms of extending the stimulus package, being more proactive and focused on employment and jobs creation.
And you want them to do that.
They should be doing that, and more of it.
All right. Well, all right. Thank you very much, gentlemen.
You're welcome.
Many thanks to Edward Stuart, Jim McDonald, and Rebel Cole.